Good morning, everyone, and welcome to Practical Considerations about Succession Planning. I'm Vinny Civitello, Communications Manager for the New Jersey Business and Industry Association. With us today is Lee Boss, the Managing Director of the Mercadian Group. A few housekeeping matters before we get started. Today's webinar is being recorded and will be emailed to you tomorrow, along with the PowerPoint for today's presentation, so be on the lookout for those. I'd also like to draw your attention to the Questions tab. Lee would be happy to take all of your questions, so don't hesitate to write them in as they come to you. And I can't stress that enough. Write them in as they come to you because you might forget what you wanted to know by the time we hit the Q&A. So now let's get things started. Lee?
Great. Well, thank you, Vinny, and welcome everybody to this very important webinar presentation. We actually have a pretty good broad representation of participants today, which highlights the importance of this topic. We have both business owners as well as those who advise clients relative to their business and succession planning. Today's presentation, we're going to interject a little bit terms succession planning, but we're also going to refer to that as exit planning. And those two terms we'll use interchangeably today. It's such a critical topic as we look and talk to our clients, and what we've seen evolving in the marketplace is the aging demographics of baby boomers and business owners, how they're really thinking more about what they're ultimately going to do with their business and how they're going to capitalize on all their hard workings throughout their careers. This is a really important topic, and that highlights the importance of working not just in the business, which many of us do, and it's a very important element of what we do every day, but also working on the business, which is a very critical element to make sure that what you're doing every day is ultimately directing you in the path that you want to be at ultimately. Just a little bit of background on myself. As Vinny indicated, my name is Lee Boss. I am a managing director with the Mercadian Group. Our firm's been in existence for over 50 years. And we're a diversified regional CPA firm. We have an accounting, CPA tax practice. We also have a business advisory practice, technology consulting, and wealth management. And we've been in business, as I indicated, over 50 years and working with a number of different industries and private companies, many of them being first generation, second generation, some of them ultimately getting to the third generation, although that's not so common these days. It's very difficult to get to the third generation of ownership. But I chair our firm's private company services group, which is focused on commonality of privately owned businesses. Those could be in all types of industries, could be manufacturing, distribution, technology, professional services, architects, engineers, financial services, but with the commonality of the issues that they face. And one of the more critical issues that business owners are facing today is this area of what are they going to do with their business? How are they going to succeed it? How are they going to transfer the value? Either that could be to the next generation, it could be to an inside management person within the business, or an outright third-party sale. Our firm's member of, and we'll see this throughout the presentation, the Business Enterprise Institute, which I will refer to as BEI throughout this presentation. BEI is the premier resource and network for advisors who focus on exit and succession planning. A lot of good resources. We'll see some statistics from a survey that BEI produces that it will shed some very insightful information on this topic. A little bit on the agenda today, and before I get in there, I just wanted to indicate I am a partner in our firm, and one of the values that I see is working not only with my clients as a business advisor, helping them succeed their business, but also as a business owner myself. And I've been very fortunate in my career to sit on both sides of the table, helping our firm think through succession planning and where the firm will ultimately succeed, as well as helping my clients do the same thing. So today's agenda, the purpose is really a high-level overview of this topic, succession and exit planning. We're not necessarily going to get into a deep technical review of some of the considerations, but what I want everybody to walk away with today is a practical approach to it. I think one of the challenges is that it often comes with it a lot of uncertainty. And sometimes when there's a lot of uncertainty in business issues and in life in general, we have a tendency to delay and defer and not really address the issue. And I think what I want to present today is really a bit of a simplified approach to how to tackle this, because I think overcoming that fear, getting started, is really half the battle in this area. So we're going to review some succession and some exit planning survey trends that BEI has produced, and I think you'll find those very insightful. Understand a little bit of the benefits of properly prepared succession plan, approach to doing it, some practical considerations, and talk a bit about a plan, how you get all this into action. And then we'll open it up at the end for some Q&A. So hope as I go through this presentation that you gather your thoughts and some comments and submit them. As Vinny indicated, we will take those questions at the end. So just a bit of survey results, and this was a survey that was conducted in the year 2016, so relatively recently, of business owners by the members of BEI. So it was a pretty wide encompassing survey of business owners and what their thoughts and some of their insight on succession and exit planning. So let's take a look at some of these survey results. I think you'll find them very insightful. So 79% of business owners plan to exit their business in the next 10 years. And I think this really highlights the importance of this topic. Again, why I believe it's gotten such broad-based interest in today's webinars, that baby boomers are aging, and they have to think about where they're going to take their business, how they're going to liquidate, how they're going to harvest the capital for all their hard work throughout the years of their working careers. And it's a real critical topic. It also highlights that 80% are still planning to exit in the next 10 years, which highlights in some of the economic downturn and uncertainty we had in 2007 and 2008. And what we found were a number of businesses really delayed their exit planning. They really focused on tightening the belt, really focused on working in the business, and many kind of not as much focus on working on the business. So I think it highlights the importance today of that. If you're out there as a business owner, you're not alone. There's a ton of businesses out there that are going to embark on exit and succession planning activities and a significant amount of transactions, either sales or transfers, over the next 10 years. Actually, I think 10 years seems a little bit long. I think we're looking more at probably within the next 5 years. So 75% of business owners would exit today if their financial security were assured. And what this highlights to me is that our business owners in this demographic are ready to retire today. They would like to retire today if they could, but the challenge that they have is they're concerned about either their current sources of income or how they're ultimately will harvest the capital of their business. So definitely want to do it, and they're ready to retire, but as we indicated the slide before, they haven't yet retired and sold their businesses. So 80% of business owners believe that a successful exit will result from careful planning. And so this highlights to me the importance of this topic, that business owners understand that in order to properly succeed and exit their business, that there will be significant amount of planning and coordination and strategy behind that, which highlights the importance of today's topic. 78% of business owners have discussed their exits with their spouses and family. So it really highlights the emotional concern. There's a lot of emotion around transferring your business and retiring at some point. And that emotional concern is very high, where 78% have discussed that with their families. However, only 18% of business owners have talked to someone whom they considered trained or an expert in exit planning. So again, it highlights that there's concern. They understand that there's a lot that has to be done here, but only 18% have actually talked to somebody at this point about putting a solid exit and succession plan in place. 17% of business owners have put their plans in writing. 38% of business owners have done nothing at all. So while many of you may be in the camp that have started to do exit planning and have had discussions. I would wager a bet based on these statistics and what we've seen in the marketplace that many of you are just embarking on this journey. And it really highlights the kind of old saying that those who fail to plan to fail. So I think planning and thinking about this is the first step, realizing that you have to start doing something. And we'll see in the presentation how there's a value to doing and to planning. So the universal truth here is that 100% of business owners will have to leave their business at some point, willingly or not. So it's inevitable. Business owners will have to leave their businesses. So it's really about how you want to do it and how and making sure that it meets your objectives. So just a brief overview of what is exit planning. And again, we use exit planning and succession planning, those two terms kind of interchangeably in this, but it's really a process that results in the creation and execution of a strategy to allow the business owner to exit the business in several different ways. And the key here is that it's really the development of a strategy, that great things don't just happen haphazard. They happen because there's a strategy, there's objectives, there's a goal in mind, and we work on it, and the business owner works on it to make sure that it is accomplished. Generally, the exit planning results in a controlled or planned fashion of an exit on their own terms and conditions. It requires coordination with various advisors, as there are some very technical aspects of a properly planned exit plan that have to be involved with attorneys and risk management and CPAs and sometimes investment bankers and valuation specialists. But the exit planning also should maximize value while minimizing risk through this process. So it's really a key term here, and many of you have heard about exit planning, but today's goal is to give you a little bit more detail on that. So the value of exit planning is really, we look at it in three different categories. It's maximizing value, and how you define value is a critical component of that. Minimizing the risk to the chance of a properly planned and executed succession or exit. Minimizing risk to the business itself, and minimizing risk to the shareholder and all the employees. And we often look at this area as not putting anyone in harm's way, is the way we like to talk to our clients about minimizing risk. And staying in control, and how you define that. Everybody has a different viewpoint on what control is and how much control they want and how much control they want to let go. So the benefits of exit planning are really, we look in those three areas: maximizing value, trying to generate the highest business value that you can, gaining and maximizing industry leadership and reputation, minimizing risk both during the transition and minimizing the risk that you're paying excessive or unnecessary taxes in the process, and there are strategies around that to help reduce that risk, and staying in control on your own time frame, on your own terms, and set the business on the course that you think is best. So, kind of the contrary to exit planning would be doing nothing at all, which, if you wake up and you realize that now is the time to sell the business, and you haven't thought about what you want to do with the business or what your various options are, or put in place the right strategy, you're really left with very limited choices. You may have to sell it at fire sale prices, you may have to liquidate it, or maybe you just have to close shop and shut down the business completely. So you can kind of see the stark contrast between exit planning, the benefits, and the other option, which is doing nothing at all. We will talk a little bit about some of the benefits of exit planning, which I think are some secondary and maybe third benefits that come out of exit planning. Is one, really thinking about where you're taking the business. Again, working on the business, not just working in the business. What's the strategy? What's the outlook for the business? What do you have to change to remain competitive? What about your personnel, the talent pool that you have? Who do you need to develop to help grow this business and take it to the next level? And what type of processes need improving? How can you make things more streamlined? And what impact will innovation and changes in technology have on your business. So this process is a bit more than just succession or exit planning. It's also thinking about your business in a broader way, and also thinking about what you want to accomplish as the shareholder. And we'll get into some more discussion on that. So there's really only three options when it comes to exit and succession planning. And this seems very simplistic, but you either have an inside sale, you're going to sell it to a key employee, or transfer or sell to a key family member. That could be a child or children or other family members. Or a third-party sale, which could be, to an outright third party, or perhaps you retain in a third-party sale still some ownership interest in the company. Or death. And I think, that seems a bit morbid to think about, but those are really the three paths. And sometimes as we'll talk some more about this in the presentation, we may kind of look at each one of these. Hopefully we don't look at death, although it's an important thing to consider as we're doing exit and succession planning. But we may actually run parallel paths at time as we go through the planning process. So fundamentally, to keep it simple and to say, how do we deal with this practically, is something that I like to say, really identifying the gaps. And the gap is an evaluation of what do I have currently. It's financial resources, it's accumulation of wealth, it's your current state of the business, what type of leaders do you have in place, what's your market differentiator, how do you make money, and how do you increase profitability, versus what do I want. And what do I want starts really about identifying your ultimate goals and objectives as a business owner outside of the business. And so any properly planned succession will involve, first, before we start saying let's talk to third parties, or let's identify if there's someone internal that might be able to succeed this business, or whether I want to give it to Johnny, my son, and try to get to a second or third generation, is really understanding this issue. What do I as the business owner want? What's important to me? And we spend a lot of time with our clients, and business owners should spend a lot of time with their advisors and looking inside deep to answer this question. So this is the first leg of the methodology from a practical standpoint to do a proper exit and succession plan. So what do I have, and what do I have as a business owner? You want to try to quantify what you have to the extent you have, and there's a lot of tangible and intangible aspects here, but quantifying your resources as far as what's your business worth today, and that takes many different areas. We get this question a lot, is, well, how do I determine what my business is worth? And there are general rules of thumb and things that you can look at in your industry as far as what other businesses have sold for, what the trend is. Often you may have the role of an outside business valuation specialist or investment bankers who see what businesses are selling for in your industry. But there's definitely a key connection here with succession and exit planning, is if you have enough time to work on the business, you can actually help grow the business value over a period of time, focusing on the key business drivers, which we'll talk a little bit more about shortly. Understanding what your annual free cash flow, how much cash does this business generate each year, and what has been the normal trend of that, to get a handle on what type of resources are available. And then also looking deeply as the business owner to understand what other type of non-business income might I have, or non-business type assets or net worth. And this is the crux of the matter, is most business owners today, when we look at businesses, it's their most important asset. They may have accumulated some assets outside of the business, but by far the value that they have in their net worth is really tied up in their businesses for most business owners. So a couple things is, what do I need in order to exit? What must I have? And again, this is asking the question, trying to get to the heart of the matter, is, would you be willing, and do you have the financial resources to exit the business transferring ownership and control without the assurance of some type of financial security. So basically, how wealthy are you outside of your business? Do you have enough financial wallet outside of the business that you can transfer this and really still sleep at night? That's a real important question and something that has to be evaluated. And what's the amount of annual income pre-tax that I would need to survive post-tax? This gets to resources that you currently have, longevity, expected time frame, what type of expense habits you will have in retirement, traveling, seeing grandchildren, doing those type of things, charitable giving, and so forth. So you really have to quantify what that level of income is that you need. And then also understanding what type of legacy you might want to leave to your family when you pass away. And it's very important throughout all of this that we have accurate information to get a sense of what you have. So then the question is really down to what do I want? So we have an accurate depiction of what I have, current resources, and we need to understand what you want as a business owner. And there's some universal goals that are part of all exit plan, which is really when do I want to leave the business? And this is actually an interesting question. It seems very simple, but many business owners say, when I'm 50, when I'm 55, when I'm 60, I'd like to retire. I'd like to be in a position where I don't have to come to work every day. And other business owners are, their passion is tied. I mean, their life is tied to their business so closely, and they really enjoy it that they say, I would like to work until I'm 70. And we've heard this from clients till I'm 75. So it's really important to understand your time frame that you want to exit the business, so you understand what you're working with at this point. How much income or capital do you want in excess of your financial security need? So how much do you want to build up over a period of time? And who will succeed me? If you're looking at an internal succession or a sale to an insider, really the question of who will succeed me is very critical here, and we challenge our clients and ourselves to think more broadly than just the way things are today. So it's easy to look at your current business and say, well, yeah, we know what we do today, and we know that John might be a good candidate. He's got a lot of great attributes to succeed me in my leadership. But the question is, and where we challenge is, well, what about tomorrow? What are the attributes of a successful owner, CEO tomorrow as things evolve and as things change, as we see more innovation and technology? It's a really important thing to really contemplate and evaluate. And then, do I want my family to receive this level of income if I don't survive, which is another important criteria here. So we really look at some values-based objectives as we talk about planning the business and succeeding it. And value-based objectives are really getting at two very important questions. One is, what's my vision for the company without me? So, where do I see the business? Where do I see the business and the company without me? And then what's my vision for me without my company, which is just as critical as the first question. And it really highlights the point that business owners that we see, they really live in the business. And in many respects, the business and the owner is one and the same. But when the business is transferred or sold, the question is what happens to the company and what happens to the shareholder? What passions do they have or things that they may need to focus on in a retirement type phase. So it's really this exercise and asking these questions really separates the two and will help define what the ultimate goal is for the exit and succession plan. So a couple things that in these value-based objectives that might be considerations is when you retire, what do you want to pursue? What are your personal goals? Is that travel? Is that spending more time with your grandchildren? Is that spending more time with your hobbies? Is that picking up some new hobbies? I have a number of clients that always tell me, I love golf, I play it, but not that much. But when I retire, I want to play it every day. So what do you want to pursue? And what about maintaining family harmony? This is a real critical area and one that we've seen with several clients over the years where they have some members of the family involved in the business, but some members of the family that are not involved in the business, or involved in the business, but they don't have the competency or the commitment that other members of the family may have in that business. And how do you really kind of balance that out? And there's a lot of good success stories that we've had of looking outside of the business and assets and wealth and being able to transfer different assets around to kind of balance out the equation. But family harmony is a very important question of what you're trying to accomplish. Legacy, do you want to leave this business and have a legacy? Maintaining the culture is another area. A lot of business owners have worked hard to build a certain culture within their business, and the question is, do you want to have that culture maintained, or is that not such an important thing to you? Another important factor is your objective to continue to provide for your employees, continue to provide in the community, be a community steward, focusing on civic and charitable activities. Is important that you take the business to the next level or minimize taxes. So this part of the succession and exit planning is really focused on really getting to the heart and the emotion of the business owner to understand where they want to be personally and where they also want to take the business and the company. Some business owners say, I'm not that concerned, about providing the culture and the continuity, and so maybe a third-party sale is something we'll do our diligence on the third party, make sure it's the right fit for the company, but kind of that continuity is not, and legacy is not as important to me as getting maximizing the value and getting that financial security. Whereas other business owners will say, when we look at our overall non-business assets, we're doing okay and we need to get a certain amount of value for the business and continue to receive that income. But what's really important for me is to be able to continue to provide for the current employees I have, or continue to be out there in the community as a business making an impact, or leaving that legacy. Those are really important things. And another area that's not on here that we've seen that's an important question for business owners is, what do you see your role in the company going forward after the sale or transaction? We have many clients that they want to still stay involved in the business in some way. And an inside sale often allows them that flexibility where they could still play some role or position. Maybe they sit on the board of the company. So there's a lot of things to really ponder here and get to the heart of the objectives of the business owner. So once we have all that in mind, we still have to determine, what is there? Is there a gap? And here I'm speaking more in financial terms as far as taking an inventory of what I have. Current assets, wealth that's been accumulated outside of the business, if that's in retirement plans or IRAs or just real estate and other type of assets, and what do I want or what do I need basically to survive and to make it in retirement and possibly leave a legacy for my heirs. So simplistically, we try to keep things simple to the extent possible. Is there a gap? And it's the difference between determining what I want and what I need, subtracting what I have, the current resources, and the result is the gap. It's possible that the gap is negative, where you have what you have is much less than what you need, and it's possible that when you do this analysis, you actually turn out ahead, and there is no gap. So if there's a gap, the question really comes down to, how do I close that gap? Which is a real important question, and one of the benefits of doing this with enough time and thinking through it, because there are strategies that you can actually close that gap over a period of time. But the issue and the challenge for business owners is that they need enough time to be able to identify that they actually have a gap to be able to work on these strategies. So closing the gap, there's a few things that we look at here of closing that gap is growing what we refer to as transferable value. And that's a concept that many of you may have heard and many of you may not be familiar with, so we'll explain that. And then how do I minimize risk during this period as you're looking to close the gap and looking to execute a succession or exit plan? you really need to think about the risk of things not going as planned, the risk that something adverse occurs and how you might be able to mitigate that. And then a topic that's near and dear to our hearts as a CPA firm is how do I reduce or avoid or minimize taxes over a period of time? So this transferable value, this John Brown is actually the founder of BEI, which I indicated we're a member of. It's the premier succession and exit planning group here in the United States. And I think his quote here really captures transferable value very well. It's ultimately your success is measured not by how well you run the business, but by how well the business runs without you. And it really highlights that in any business and situation that the value is actually grown or increases exponentially as you're able to make yourself as the business owner irrelevant. Basically where the business could run on its own without your involvement. And that's really going to grow what we refer to as transferable value, something that either a third party or even an insider would pay maximum value for. So let's talk a little bit about growing transferable value. What are some of the things to think about? And hopefully we'll kind of nail down this concept a little bit more for each one of you. So we really look at value drivers when we talk about growing transferable value. And again, it's really this first point, this first red box really nails it down, is that the owner's role is working on, ultimately in a strategic capacity, the business and not necessarily in the business. And I have a number of clients that have done this extremely well, where they've been able to develop a leadership and a management team and over time work with them, mentor them, coach them to the extent where the business owner really doesn't have a big hands-on role in the actual business. Now they're still an advisor, they're still on the board of directors for the business, and they're still critical as far as the culture and things of that, but it's not necessary that they work in the business every day in order for that business to succeed, which really highlights developing that next level management talent. So what happens if the owner leaves? So businesses and institutions that maximize value are really able to take the concept and take all the great things that the business owner did and really make it a life to itself, where the business can sustain without that business owner. Developing systems that improve sustainability of cash flow are critical. Basically, all the processes and things that you do to take the inputs that go into your business and produce an output, whatever that might be, are processes that convert those inputs to outputs, and developing systems that are very automated, where it occurs without a lot of manual intervention, and that can be repeated without necessarily the expertise of one person, really helps drive sustainability of cash flow and helps maximize the value of the business. And then we talk about just having this create and execute a written growth plan. So growth is very fundamental, obviously, and we'll see that in particular as businesses are sold to third parties and insiders, that we're looking at how the business will grow over time to help sustain the business. And many times there's a cash flow or a payment obligation to the owner to buy out the business. So growing the business, growing profitability has a real important part here to do that and do it successfully, and also minimize the risk to the business owner. So a couple things as we look at minimizing risk to the business, it's really, this is, what would happen to our exit plans if these things were to occur. So there are a lot of strategies that will help, minimize these risks to the business and things that can be put in place. So for example, one of the risks to the business is that you're tailoring and you're coaching and developing future leaders. And what if one of those key employees leave or they decide to compete against your business in such a way? So there's standard agreements, there's non-compete agreements and employment contracts that employees and key employees can enter into to help mitigate that risk. What if there's a breach of some confidential information? Again, this could be a non-disclosure agreement entered in with key suppliers, key vendors, key employees to help prevent that. If you have uninsured casualty loss, so there's insurance products that can help that. Death of a key person, again, insurance products, as well as looking at the business and saying, if certain key people were not here tomorrow, what would we do in that case? And what we call emergency succession planning, which is also a very critical element of any properly planned succession plan, is looking at what would happen in the event that would happen, death of a key person or death of the owner. So these are really things that as you go through your exit planning, we want to focus on, and there's probably in any given case when we work with businesses a ton of other risks that are not on this slide. So it's really important to strategically think and analyze about what all those risks could be and are, and then how you can minimize those over a period of time. So not to get into some of the more technical topics about how, or some strategies to help reduce, defer, or eliminate taxes, but it is a consideration as part of an exit and succession plan is twofold. One, are there certain structures, which there are from an estate planning purpose, which may help to minimize or lock in the value today for a growing business, which would help to minimize potential tax bite down the road? Or there are things that we could do today which would just help put more after-tax profits in the business owner's pocket so that they can grow wealth outside of the business. And we've listed a number of kind of strategies here and things that are considerations. Using lowest defensible value is a discussion point in transferring wealth or transferring ownership interest to trusts at the lowest value possible. Taking advantage of certain valuation methods and things such as the lack of control or lack of marketability or lack of liquidity of the ownership in the business. And really that's a whole separate topic of discussion that could take a whole day webinars talking about various estate planning tactics and trust, use of trust to do this over a period of time. Business entity choice is also a critical area. We have a lot of changes that we're advising clients on right now with the Tax Cuts and Jobs Act that went into play, that was signed by the end of 2017, and which will start going effective in 2018. But business entity choice is a real key one. As C corporations, as an example, have something that a lot of business owners are taking a look at harder now than perhaps they have in the past, with the rate going from 35% down to 21%. There's still the S corporations, LLCs, sole proprietorships, partnerships, but business entity choice does have a key factor in, looking at taxes and tax planning. Qualified plans, to the extent that there's an opportunity for a business owner to put more money into a qualified retirement plan while the business continues to grow and grow retirement income outside of the business, is definitely a strategy to help in the succession and exit planning. To the extent that you could reduce some of your state income tax. So a lot of businesses start looking at other jurisdictions that might have more favorable tax rates. Heard clients, we've worked with clients that have been unfortunately relocating to Nevada, Florida, and things of that nature to take advantage of that. There's some benefit. There's another discussion about ESOPs that, again, could be a whole day discussion about the value of an ESOP and how an ESOP could, properly structured, help minimize or even eliminate taxes, especially if it's an S corporation entity that's owned by either partially or fully by an ESOP. An ESOP is a really good mechanism for business owners that want to transfer ownership, not just to a key family member or a key person or a third party, but transfer that ownership to the actual employees. And there's a lot of different strategies around that. Charitable transfers, tax-free mergers, and this estate tax, either elimination or reduction through various estate planning strategies and the use of various trusts. So again, didn't want to get into all the technical details on this slide, but there's a lot of things to consider, and this really highlights the role and the value of having a proper advisor in this process. So just quickly, the different exit paths, we already talked about these. There's really just three that you can pursue, but often you will look at some of these together. So for example, I've had many clients that say once they understand the objectives and what the business owner needs, they'll say, well, we're not quite sure. Third-party sale might be something we'd like to entertain if we could find the right dance partner. And an inside sale might be something that we would like to entertain. And one of the challenges here is that the things aren't done in a vacuum. So you may think that an inside sale is the right path for you, but the question is, do you have a willing buyer? So you may be a willing seller and you'd be willing to sell to your child or transfer to your child or another family member or key management. But do they want that opportunity? Do they have the financial resources and the commitment to withstand that over a period of time? So often we do these kind of together, and I've seen clients where they go down both paths. And they evaluate what an inside sale would look like and how things need to be structured properly to do an inside transaction, and then they also speak to third parties to get a sense of kind of what's out there in the marketplace, what valuations they may be offering them, what type of deal structures they could provide to them. And then they circle back and they really do a deep dive comparison, cost, benefits, pros, cons between both of those strategies. So just want to talk about the inside sale. And this is when people think of succession planning, they're really thinking of inside sale for the most part, which is why we kind of broaden the discussion here to exit planning. But on an inside sale, it's actually one of the most popular, between an outside sale or an inside sale or third-party sale. Selling to insiders is actually the exit path of choice for most business owners. Actually, greater than 60% of transfers occur to insiders, and you can see the breakdown of that: child, family members, about 24%, key employees, co-owners or ESOPs, 41%, versus 29 or about 30% to a third-party sale. So it is a very popular way to transfer, is to do it to an inside sale. So there's three real benefits that we list out here. One is in an inside sale, you can pick your successor. You can kind of determine who that is, either family member, child, key leadership, or a combination or a group of those. You can better control, have main of control, and you can achieve those value-based goals a little bit easier if you say, I want to maintain the culture of my business, I want to leave a legacy, I want to continue to focus on the community, I want to be able to have the opportunity to continue working in this business. But it doesn't come without some challenges, and probably the number one challenge, without a doubt, is that typically the insiders don't have money. They don't have deep pockets that they can just write you a check. So typically in an inside sale or an inside transfer, what we call the seller or the owner is taking paper. And what we mean by that is they're taking notes, they're taking a promise that the new ownership will pay them over a period of time. There's also a challenge that, if you were to sell today, you'll lose control and you're not getting cash, you're not getting paid, you're going to get paid over a period of time. There's a challenge that we hear is, well, the business can't run without me. I'm so critical to the business that I need to be there, or that the business isn't worth enough today. There's also another challenge that we've seen, which is where you have the dynamic of multiple children or family members within the business, and the question of how do you deal with certain children or family that either are not involved in the business or are involved in the business, but you don't see them as being one of the key leaders or owners of the business. So, and there's strategies around that, but that has been a challenge for an inside sale. So overcoming the challenges, a few things, is if you can minimize tax consequences of the transaction, essentially putting more post-tax money into the pocket of the owner over a period of time, or allowing more post-tax money to be in the business, that definitely helps minimize some of the challenges about affordability and so forth. There's strategies that you can maintain control through voting and non-voting classes of shares or membership interest, and where the business owner actually still retains units or shares of voting shares, and the incoming generation or owners have non-voting stock, non-voting units for a period of time. So there's a way to maintain control. There's also a way to do it as a creditor. So when the seller sells, they take paper, as we indicated. It's basically a promissory by the buying generation that they will pay the seller over a period of time. And there's ways to structure in that promissory note certain creditor protections that give the former business owner protection that, that they still have maybe a voice in the business or have to approve certain decisions, or that if things really turn bad, that they could force a sale, similar to the way, a bank may be in a position with bank covenants and so forth. So it's also critical that when it comes to an inside sale, that it's not always about the business value. And we hear this from a lot of business owners. They say, it's not necessarily maximizing the value, it's structuring a transaction at the right level that, it accomplishes all the objectives. I get the money that I need and security that, the new shareholders can afford it, and that we accomplish all of the objectives. So just on a third-party sale, again, often you'll go down two paths where you evaluate an internal sale and also a third-party sale. But third-party sales generally being to either a financial buyer, and often this would be like a private equity group where they're really concerned primarily about maximizing the return or returning money to their investors at some point. Or the other option is a sale to a strategic buyer, which could be a competitor, a customer, or perhaps someone else that really looks at the business and says, we could kind of take this business and take it to the next level. We could integrate it into our product offering and really maximize value over some period of time. There's also options of having either a full or a partial sale. So you don't have to necessarily sell 100% of your ownership interest. You might be able to retain some ownership, perhaps a minority ownership, where if there's ultimately another sale down the road, that you would actually get what we call a second bite at the apple. So very important to consider. A couple of the benefits, just the speed, which with this transaction could occur. Generally, there's more cash at closing and cash in the pocket of the business owner. And typically, it will be maximizing the price of the transaction. So some of the challenges that the business may not be ready for a third-party sale. There's likelihood that there'll be earnouts, which essentially would be, rather than the owner getting paid 100% upon closing, they may get paid based upon satisfaction of certain financial metrics over a period of time. If you make those metrics, you get paid out. If not, you don't get that level of value. You may still have to take some owner notes, which we call taking paper, and your value-based goals may not be met. So there's ways to overcome this, as there is anything with proper planning, is that we actually do a pre-planning or pre-sale planning, which is looking at the business and really evaluating, is the business ready to be sold? So we look at the business and do what we call sell-side due diligence, which is looking at the business and saying, what are the things that need to be worked on to improve the business so that when we ultimately go to sell it to a third party, these issues won't be raised. They're already addressed. There's also the issue about how you go about this process, making sure it's very controlled, because the last thing you want to do is, put the company up on the selling block, and then the employees become aware of it, your customers become aware of it. You have issues with employee morale, you have vendors or customers that might leave ship, you have employees that might leave ship. So it really has to be a controlled process. And the other point that can't be overlooked is that you have an owner that's actually ready to sell. So again, it gets to the emotion, it really gets to the planning of, okay, if this is where we're going to go as a third party sale, we need to prepare the business as well as the owner for what that's going to look like. So just real quick, death, we talked about this exit path, which I don't think anybody really wants to think about, but it does highlight the importance of what we call emergency succession or emergency exit planning. And every good exit or succession planning should contemplate this as well. So traditional exit and succession planning is orderly, it's got time, there's different strategies, but An emergency succession planning is what happens if the owner or key leadership gets hit by the bus. So we want to think about that. We want to think about the likely impact to the business. What are the key leadership roles that person has, and how can we mitigate that? How can we put in place a plan where if that were to occur that same day, the very next day, we can take out this exit plan and we could say, okay, Bob, the owner, was responsible for all these things, but now Jim, the son, or Jim, the vice president of operations, is going to handle these aspects of what the owner was doing. So it's really important to have a properly planned emergency succession plan as well. So a couple of the things, the risk, if I die tomorrow, will my business continue? Questions about who will step in your shoes, who can take over your roles and responsibilities. There's issues of estate tax if this business ultimately will not transfer to a spouse. Is there adequate liquidity in the entire estate to pay for any tax that might arise due to the value of that business that's within the estate? We've seen some horror stories where businesses have had forced to liquidate or sell basically to pay the estate tax, which is never a good answer. Value, so if I die tomorrow, will my family have sufficient income? Really touches to the need for proper insurance analysis in place. And then control, if I die tomorrow, who should own my business? So again, looking at your estate planning and properly planning that in your estate, addressing that question. So as we said, any good succession plan is will be committed to writing. And here's kind of just a broad overview of what that may look like. A plan that describes your goals, what your existing resources are. So really addressing that issue of what I have and where I need to be or what I want. And then addressing the various gaps with some recommendations of either how we're going to grow value, how we're going to reduce taxes or minimize taxes, how we're going to minimize business risk, and creating a written plan defining the exit path, choice and design recommendations. Again, as we talked about, it could be a transfer to a family, sale to management, sale to a third party, sale to an ESOP. So really laying out some of the viable options and kind of pros and cons of each strategy as part of this written plan. And then for each recommendation, what actions have to be taken, the due date for completion of those actions, and who's responsible for accomplishing each one of those. And it's very important that we have a good coordination of these activities amongst multiple advisors. So we always say there's really not one person that can address all the technical aspects of an exit and succession planning. That's very hard to come by. So it's really important that you have an advisor that you work with that will kind of quarterback this process and bring in the right level advisor, somebody that you trust, that's competent, that's qualified, and somebody that will also monitor it and kind of keep you accountable to this plan. So here's just an overview of that concept, the role of advisors that are involved. You have the business owner, and in a properly planned exit and succession plan, there's a number of different professionals that are going to be involved in this process. You have the CPA from the tax planning considerations. You may have a transaction intermediary, which would be an investment banker that would help provide guidance and go through the process of investment banking services. You have an asset wealth management manager, financial planner, business attorneys are very critical in this process, and so forth. So just conclusions, some of the ingredients of a successful exit that we see, it's really based on the owner's objectives. You have an experienced team of advisors to design and implement the plan, having cash flow and a quantified business value, strong management team in place, and probably the number one thing that you need is focus. You need to have focus on it and ample time to successfully implement your plan. So with that, I'll turn it back to Vinny, see if we have any questions in the poll.
Thanks, Lee. I know we're coming up on the 12 o'clock hour. I just want to let everybody know I'm going to keep Lee strapped to this chair until all of your questions are, in and done. If you have to go to lunch, feel free. Everyone who's signed in today will get a recording of today's webinar emailed to them tomorrow, so you don't have to worry about missing anything. But if you want to stay on, I think that would be great. So we have a couple questions already, but I want to give everyone a second to type in anything they have. So while I'm doing that, I'm going to take a second to remind you about the Handouts tab. It's right there on the right of your screen. We get a lot of questions from people about how do we download the slides. So you just open up the tab marked Handouts in the GoToWebinar panel, and the file is right there. You can also just wait until tomorrow, and they'll be emailed to you along with the recording. There's also the Questions tab. So if you have a question, type it in right there, and I'll make sure Lee answers it. And don't be shy. You've got an expert here. And I always ask myself, you're going to get a post-webinar evaluation survey when this is over with. And whenever somebody writes in a question that's something like, I came on really hoping he'd touch on this, or I thought he'd be talking about that, I always just ask why they didn't ask the question. So you've got an expert here, take advantage of them. Our first question comes from Selena, who would like to know, how early should I start succession planning activities before I leave?
That's a great question, and one we get often, Selena. It's interesting, and we always kind of caveat that it's never too early to start exit and succession planning. Actually, even as a business owner that you're embarking to start a new business, it's always good to begin with the end in mind and think what your ultimate objective is for this business. But with that, it's kind of sometimes a fantasy though, right? As we talked about working on the business or working in the business. And so often we're very heavily involved in working in the business and we don't get enough time to work on the business. So realistically, it's best if you could do it at least 5 years before your ultimate date that you want to have a transfer either to an inside or an outside sale. But again, the earlier the better, the sooner that you can start working on it. We talked about some of the benefits that happen when you really focus not just on succession and exit, but about strategically thinking about your business and where you want to take it and strategies to continue to grow it and plan it so that you have that transferable value that, at one point you basically make yourself irrelevant to this business. That's really, I think, the ultimate goal for all the business owners out there.
Very cool. Jonathan wants to know, how do I best coordinate the involvement of all of my professional advisors?
It's a great question, Jonathan, and one that I think is challenging. As we indicated, there's a lot of different advisors to do this right, to get really the best in class thinking. And I think it really starts with identifying somebody that you really trust and that you respect and that you feel confident that you can have open and honest communication and discussions with, and somebody that will hold you accountable to that. So I think it requires a little bit of soul searching and an evaluation of who you think can fill that role. Somebody that you trust, respect, and somebody that's skilled in exit planning is very important as well, that they have an idea of kind of all the different twists and turns that this may take over time.
Lisa asks, what is the average cost for a business valuation?
That's a great question. Another one that does come up often, and it's hard to give general rules of thumb as far as cost. But I could tell you that generally I've seen business valuations anywhere in the ballpark of maybe $3,000 on up to do it properly. There's some actually free sites and information out there that could kind of give you like a back of the napkin estimate as far as what a business is worth. But truly, to have a business valuation specialist take a look at it, there is a certain amount of work that's required. They're going to look at your actual financial information, historical finances. They're going to understand your business, how you make money. They're going to want to take a look at projections of your business. So there's some work that has to be done there, and to come up with a reasonable valuation.
Jack says he has received several unsolicited offers to sell his business at an amount he thinks is fair. How should he invest in succession planning if he can already get a fair value himself?
Yeah, that's actually a very interesting discussion, and fortunately, there are some businesses out there that get these unsolicited offers, and they're kind of, what do I do with this? And, is this a good deal for me or not? And I think it still comes back to the question of, well, that's a good value today, but do you think you can actually continue to grow the business, work on the business to where maybe you get an offer at some point that's 3, 4, 5, 10, 20 times that value, which I think is really an interesting thing to contemplate. And then also, what's your goal with the business? It's not always necessarily getting the highest and best value for the business. So you have to really think about that offer, the counterparty that offered it to you, what are their objectives, and what are your objectives? So, but that is a good thing to have. An unsolicited offer is always a good thing to have, but something that I think you really have to do a lot of soul searching and think about it.
So I just want to let everybody know we have 2 questions left. By all means, keep them coming. If not, then we'll sign out after the 2. So Pamela has a question that I think you kind of touched on, but fortunately, Lisa has a follow-up. So Pamela's question was, how do I get a sense of what my business might sell for? And Lisa asks, as a follow-up, what is the free website for a rough valuation that you mentioned before?
Lisa, I'll have to get back to you on the question of the website. I do have some resources out there that I've directed clients and prospective clients to as well. So I will get that back to you. But what the business might sell for, that question is a very good one. And I think, again, it's having some preliminary discussions with your team of advisors to understand what they've seen out in the marketplace. There's a lot of valuation specialists as well as investment bankers that would offer, to have a consultation and give you kind of a sense of what that would look like. There are kind of a lot of industry associations post information as far as what typical multiples of earnings and things like that have been typical in certain industries. So, but it ultimately comes down very, very kind of fact-based for the business. Because a business that looks very similar, one business may have a valuation half of the other. If that other business is really focused on those things that we talked about, building transferable value, they have a diversified product offering, they have a deep leadership bench, they've embraced technology, they're kind of cutting edge. So all of these things really help drive the value of the business.
Edward asks, I'm on the other side, and I'd like to buy a business from the existing shareholder. What should I do?
This is a question actually that is an interesting one, because as we talked about exit and succession planning, we really focused on the current business owner, but the question is, the opportunity that the aging demographics and baby boomers presents to those that are not baby boomers, that are looking to get involved in business and really acquire a successful business. And I think the first thing that I would recommend is really having a discussion with the current shareholder to understand where they stand in their journey of exit and succession planning, and perhaps educate them if they haven't embarked on a journey yet, that one, expressing that it is something that you might be interested in and you want to learn more information about it. But one, I think to the extent that you can kind of help them realize that it's something they need to start thinking and focusing on. But as a potential buyer, there's a lot of things that you want to understand. You really want to make sure you understand the business that you're looking to possibly acquire or purchase. What's it worth? How does it make money? What are some of the historical financial trends? What's the outlook for that business and its industry? And what do you think ultimately, your obligation may be to the seller, to the current owner, to pay him or her back over a period of time? And are you in a position where you feel that you can, you're committed to that path, and that you may be able to stomach the ups and downs that businesses often go through? And just to kind of challenge a little bit more, that question is also understanding what ultimately your exit path will look like. So I think those are all very important things, but it sounds like it could be a great opportunity. And I know we've seen it out in the marketplace, a lot of really great businesses that are looking to transfer their value over time.
Another follow-up from Lisa, who asks, is a multiple of revenue based on revenue brought in on an annual basis before any taxes or costs are removed?
Yeah, so typically the multiples that we're looking at is something that's called EBITDA. So that's earnings before interest, taxes, depreciation, and amortization, which really so that would be earnings, before taxes are paid and so forth. It's really cash flow that's being generated from the business operations, really free cash flow. So yeah, it's usually looked at as far as the multiples of our earnings before taxes are factored into that. But each industry has some different criteria that it looks at. Some businesses will trade more based on a pure revenue value. So maybe 1 times revenue, half a times revenue, 2 times revenue, or so forth, depending on what the common metrics are in that industry. A lot of industries will generally look at EBITDA and multiples of EBITDA, which could range depending on the industry. Obviously, those that are in higher growth that people expect that will continue to grow and will continue to be able to capitalize on their investments might get a much higher multiple than, say, a business that's very kind of mature and maybe more on the downward turn of their business cycle.
We have one from Ron who asks, where would I turn to get a company's value when that business is not your everyday business? We are a service-oriented, but by all definition, a niche business. We are doing over $1 million annually and still growing, but no other business to compare or value.
Yeah, so just to caveat, I'm not a valuation specialist, but just understanding this, what we've seen from business valuation specialists is they're often looking at trying to take and look at similar type industries or trying to find a business or an industry that they might be able to say it's very similar to this. There is industry kind of published guides out there. Another thing they will look at is there's a valuation method where you're looking at discounted cash flows over a period of time, looking at the projections for your current business and the outlook for that, and then discounting those cash flows back to come up with a valuation. So there's multiple ways to approach and to develop a valuation. And what I would encourage you is to kind of reach out to those that are in the valuation industry, and I'd definitely be glad offline to put you in contact with some of those individuals.
Cool. Well, that looks like about all the questions we have. So I think it's as good a time as any to bring this to a close. Don't forget, all of you will be receiving a recording of today's webinar and the PowerPoint slides via email. Lastly, when you close out of the webinar, a survey will come up on your screen that we hope you'll fill out so we can understand how to best provide you important information in a webinar format. Our next webinar, NJBIA Live from the State Capitol, will take place Wednesday, January 24th. So by all means, feel free to register for that one right on our homepage, and we'll see you there. So until next time, for Lee Boss, this is Vinny Civitello, thanking you for being with us this morning and wishing you a great